On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope you're all well. I wanted to talk about the US share market today, how it's positioned over the next little while, and whether we'll see a strong finish to the year and a good performance into next year too. The US market has definitely pushed higher since the election in early November, and it's built on those strong gains that we saw in the lead up. The S&P 500 is up 27% so far in 2024. That includes dividends, and that's on the back of a very similar rise last year in 2023. But despite that 60% return since the end of 2022, investors are still upbeat and a traditional Santa rally is absolutely on the cards. Under the incoming administration, which will take office early next year, markets expect deregulation, a resurgence in M&A, that stands for mergers and acquisitions, and a reopening of the IPO market. Those are all positive signs for markets generally, and they're leading to some quite strong optimism. Policy changes aren't the only reason for those good vibes, with another impressive earnings season having just wrapped up. That was actually the 5th consecutive quarterly increase, and analysts see more gains ahead. For the 2025 calendar year, S&P 500 earnings in aggregate are expected to grow a very healthy 15%, led by the technology, healthcare and industrial sectors. Materials isn't too far behind either. Corporate buybacks are happening in earnest, and this year could actually be one of the highest on record for share repurchases. As impressive as all of that sounds, there are still a couple of caveats, as always. One is valuations, which do look high. The S&P 500 index is trading on a price-earnings ratio, or a PE ratio, of about 22 times right now. That's well above the long-term average of about 16.5 times. Then again, the likes of Nvidia and the other high-growth companies, tech companies and others, have really dragged that average up in recent years. And if you look at the median stock in the S&P 500, it has a much more reasonable PE of 18.3 times. Still expensive compared to history, but not nearly as much as some of those other high flyers. We also need to consider the fact that the US share market has changed an awful lot in recent years, and historic valuations might not be the useful yardstick for value that they once were. Gross margins for the likes of Microsoft, Apple, Amazon, they're much higher than the market heavyweights of the old days, and that's a key reason why companies are priced more highly today. In the past, high margins were typically a sign that companies were over-earning. That would have attracted competitors to the industry, weakening the position of the incumbents and forcing those margins lower. Now, that could be a little more difficult given these types of companies and how important they are to the ecosystem for consumers and for businesses. So I think things could be a little bit different now, and we might be comparing apples and oranges. While I'd be reluctant to bet against the best businesses in the world, for those who are concerned about high valuations and elevated prices, there are plenty of opportunities elsewhere. I don't think high valuations will hold the market back in the short term at least, as long as the US economy keeps performing and earnings keep growing. Now, that's never a given, but right now, economic activity is healthy, the US labour market is solid, and the Federal Reserve will keep easing monetary policy, even if it does choose to go a little bit slower. That's a positive backdrop for the share market. We still need to keep an eye on longer-term interest rates too, though, and make sure they don't rise too far, too fast. Sometimes it's the speed of an increase that causes nervousness and volatility, more so than the rise itself. I think the jobs report next Friday is a key data point to watch. This is out on December the 6th, and we'll get those figures on Saturday the 7th here in New Zealand. Last month's jobs report was very, very weak, but these figures were impacted by strikes from the likes of Boeing, bad weather and hurricanes, so it's really hard to get a handle on exactly what we'll see this time around. That will be one of the last major releases, though, ahead of the December Federal Reserve meeting. At the moment, that looks like a coin flip between the Fed pausing or cutting interest rates again. Investors would obviously prefer the latter. However, a pause because the economy is in good shape doesn't make for a terrible narrative either. The month of December is typically a very good month of the year for US shares and one of the strongest of the year in seasonal terms. November is typically the strongest on average, December is second, so not far behind. Since 1950, the S&P 500 has returned an average of 1.5% during the month of December, and Decembers have finished higher 74% of the time. Now that's well above the monthly average return for all months of 0.7% and the hit rate for all months of 61%, so the odds are on our side. There will be a lot to consider in 2025 with tariffs, inflation, and the US deficit in focus for investors. Those are all things that we'll be pondering over the weeks and months ahead. But for now, the stars do appear to be aligned for a good finish to this year and probably a buoyant start to 2025. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.